Well, good evening, everybody. Thank you for joining us. We still have a lot of participants signing on to the webinar. I don't want to punish the punctual too much longer, so I'll go ahead and get started. This is Dustin, TenBroeck, President of Presidio Capital Management, on our first edition of our webinar series, the Presidio Perspective. I want to welcome everybody tonight and especially thank you for canceling all of your Friday night plans. You know, I know that you had bars and restaurants to tour, social gatherings to get to, and you put that all on hold to be with us here tonight. You know we're living through some challenging times when the best thing that you have to do on a Friday night is tune into a webinar series with your financial advisor. So thank you all for attending with us, and those of you listening to the recorded version. I hope you find this useful. You know, we are definitely going through some difficult times right now. The news is a little overbearing and daunting, as it usually is. And I know that a lot of you want to hear from us on a frequent basis. So our plan is to have a weekly webinar where we can talk about what's going on, what our perspective is, what we should be looking at as far as investing in financial planning decisions, and hopefully give you some solidarity here as we go through this very difficult time. You know, I want to give my best wishes to everybody and their families for their health and well-being. You know, that everyone's being safe, staying healthy, doing what they can to contain this deadly virus and disease that's going on. And just like all other things, good and bad, this too shall pass. So temporarily, we know this is a very challenging time, and certainly in the financial markets, which is what we're going to focus on here tonight. You know, those of you who have attended our retirement course or have been a client of the firm know that we talk about this frequently and consistently as something that we have to deal with, exactly what's going on right now. And many of you know what I'm going to put on this slide, that the big three that we need to plan for that are far and above, more important than anything else, are inflation, taxes, and market crashes. This is something that we know that as investors we are going to experience. Unfortunately, most people's recipe or strategy for dealing with the big three is to pretend like they don't exist. Us here at Presidio, our perspective is that these three things are inevitable. These three things want to make your money worth 30, 40, 50% less, and they will, given the wrong strategy. So, you know, our crystal ball predicted that we would not predict the inevitable market crash, but that it would happen. So for us, you know, this is the playbook. We know that these things we're going to experience through an investing cycle, and I have communicated that to all of you, that this is just part of investing, and that market crashes are a reality of something that we're going to deal with, bear markets, recessions, multiple times in our life. And we have thankfully put the strategies in place for just such an occasion. We anticipate the market crashing just about each and every year. And those of you who have worked with us for a number of years know that. And so we feel very well prepared, and that we know that all of our clients, each and every one of you that has worked with Presidio, has a 15-year term or longer for their stock market exposure. And our reality is that right now the financial markets are down. It looks really bad right now. However, this should not negatively impact your life. Certainly, you know, the current environment outside of finances is impacting our lives. But from a market crash perspective, this is something we anticipate. And so we want to just review that and kind of put things in perspective as to what we do now. You know, we've been here before. We've experienced bear markets, market crashes, recessions. If we look back since 1950, there has been 9 bear markets that we've had. And two of those highlighted in bold had a flu epidemic that kind of went hand in hand with those recessions. So, you know, the Eisenhower recession in the 50s, you know, was followed by what's called the Asian flu. And the Asian flu in the late 50s was pretty bad, killed almost 70,000 Americans. Happened right at the end of a a recession. The Hong Kong flu in September from 1968 to March of 69 killed almost 34,000 people in the United States, according to the Centers for Disease Control. So we have experienced recessions, we've experienced bear markets, and we've it's funny enough, there's the Asian and Hong Kong flu. So, we'll see what we call this one when we start looking back. So, so again, we've been here before, and we wanted to take a look at these bear markets and what happens. The average drawdown in the stock market, when I say stock market, I'm referring to the S&P 500 index. On average, looking over these 9, was a 36% decline in stock price. On average, that happened over a period of 15 months. So mind you, we're about 1 month into this one. And the average recovery took just over 2 years. So that's looking back at the last 9 markets. What do we want to do when the stock market crashes? Well, the first thing that we don't want to do is sell low. The way that you make money is to buy low and sell high. The way that you lose money is to buy high and sell low. And so we can look to investors like Warren Buffett, who might know a thing or two about investing, if not one of the greatest investors to ever live. And his 2 rules of investing, of course, we should echo that rule number 1 is to never lose money. Rule number 2 is never forget rule number 1. I think that's pretty important to keep in mind, especially given where we are today. And I am so thankful that we are, one of those wealth management firms that anticipates this, and I don't have to look at my client's stock market investments and find out what I'm going to sell. Everybody has a long-term time horizon on their equity exposures, and something that we talk about a lot in financial planning is it's just math. And so everybody has a plan for the money that they need set aside that's outside of the stock market. And I got to also comment how proud I am of all of our clients at Presidio. I think over the hundreds of families that we serve, to my knowledge, we've only received 1 call so far from somebody who wanted to sell out of the stock market. So seemingly we've done our job educating you on what to do and preparing you for this event, and we hope to continue to do so. So if strategy 1 is to not sell low, perhaps strategy 2 is maybe we can buy low. And so we're going to be watching this market very closely for when that right time is. And we're not going to predict that we are going to pick the bottom. That's something that, is just like predicting when the market's going to crash. So, we kind of decide, or do you want to be too early, too late, or a little bit of both? So today, I just wanted to do a little historical study. Now, we wanted to learn what would happen if we bought back into the stock market the month following a 30% decline. Now, we finished these presentation slides yesterday, and our thought was that we were going to breach this 30% market decline, in which we did today. And so today, the stock market sell-off for this bear market is greater than 30%. And so we wanted to look back at the other times in history where that happened. And if we had bought back in the month following, so in this case, it'd be April 1st. Again, we're not saying we're doing that. But if we bought in on April 1st, following a 30% decline, what was the outcome on average over a 3, 5, and 10-year period? So if I go back to those bear markets that we had since 1950, there was, I think, 5 of them that had a drawdown, so from the high point of the stock market to the low of 30% or greater. So we've experienced this 5 times. Many of you remember some of these, all too familiar to you. However, hopefully your experiences in these markets will serve you well today. We have been here before. One of those experienced the Hong Kong flu, of course, in 1969 to 1970. So, one thing I will note about this bear market that is different than all of these others is that, we know that the coronavirus will have a significant and serious impact on the U.S. and global economy. We're not sure what that impact is yet, but we do know there will be one. What we also know is that right before that happened, the U.S. economy was very, very strong. The Atlanta Fed was projecting a 3.1% annual GDP growth rate for the first quarter of 2020. And that is a very good sign of a very healthy economy. So all the statistics prior to this supported a very healthy economy, which is not what we had in the later recessions. You know, the last one, the recession of the housing bubble and great financial crisis, the peak was October of 2007. It wasn't over 1 year later until Lehman Brothers went out of business. And so the economy was already in decline for a year before we had that significant effect. The same thing could be said in the early 2000s, that the peak of the stock market, the S&P 500, was March 27th of 2000. And so the economy was already in a downturn. And then a year and a half later, we had a plane go into a building, or two planes go into two buildings, and caused the massive drawdown in the stock market experienced by 9/11. So, and the same can be said for, well, not Black Monday, but the oil crisis and the recession of the 69 and 1970, is that what we've seen before in these bear markets when they had these steep declines is that there was a declining economic health in the United States, and then an event which triggered a snap and in a dislocation of the market and a significant drawdown. So that is different this time around. We had a very healthy economy before this coronavirus hit. So something just to take note of. So getting back to our study, if I look at the S&P 500 buying in the month following a 30% decline, reinvesting dividends, what happened over a 3, 5, and 10-year period? So looking at these last 5 recessions, on average, if you bought in 3 years later, you would be up on average 40%. So that's the S&P 500 index, reinvesting dividends would have accrued on average a 40% growth in the stock market if you had bought in a month following the 30% decline. If we had a 5-year time horizon for our buying decision, then on average, we'd be up 78%, almost 80%, 78% growth over 5 years. That's the appreciation of the S&P 500 index, including reinvestment of dividends. So I think that's about a 12 to 13% annual growth rate of what you experience after a 30% decline. And over a 10-year period, the average is your money would more than triple over a 10-year period if you had invested in the S&P 500 index the month following the 30% decline. So no two bear markets, no two recessions are exactly the same. This is, of course, different and something that we're monitoring closely. There are many things different about this than what we've experienced. Certainly different sectors that are hit. Some of those are going to have lasting effects more than others. And so we have to stay in tune to the data and see how things are going, but this too shall pass. You know, if we look at the markets, they are a leading indicator. So, you know, right now the markets are pricing in how bad the next quarter is going to be. When there starts to be signs that the coronavirus is contained, when there starts to be signs that this is going to pass at some point, that schools are going to be back in session, that airlines are going to be busy again, restaurants and bars are going to reopen. When the signs are there that that is going to happen, the market is likely to anticipate that, and you're going to start to see a recovery in the stock market before the actual recovery happens. Of course, the market is pricing in what they think is going to happen in the future. And so right now we know that the next quarter, and right now that things are really bad, certainly looks like we're going to be in a recession. People are going to make less money. People are going to lose their jobs and buy less stuff. So there is going to be some short-term pain. At some point, when the market decides that this contagion has started to look better, that you are going to see a reversal in the stock market. We're not going to pretend to know exactly when that time is going to be. So we'll be monitoring this closely, but hopefully this study helps give you a little bit of sense of what we're looking into and seeing when we want to redeploy the cash in our portfolios, and of course, meeting with our clients and adjusting their financial plans accordingly with any changes in their life. So again, coming back to the Oracle of Omaha, you know, he says, we simply attempt to be fearful when others are greedy, and to be greedy only when others are fearful. And this is a message we certainly embody at Presidio Capital Management, hence why we sold and raised cash in a booming 2019 stock market, and why we are now looking at when do we want to buy, because there is certainly a good amount of fear out there. Just as a reminder, we're here, all of us here, Cheyenne, Joe, David, Cole, Heather, Mary Jo, Matt, and myself, Jamie, we're all here to serve as your personal CFOs, and that's what we do in helping our clients live better lives. That is the mission statement of Presidio Capital Management. We have a fiduciary duty of care to you and your portfolios. So please know that I am not in any way conflicted in telling people when to buy into the stock market or when to get out. We are completely aligned, and all of our advice, of course, as always, is only that in which is in your best interest as your personal CFOs and fiduciaries. For those of you who might be a little cynical out there and say that, yeah, that's fine and well, Dustin, but I believe everyone serves their own self-interest, that's okay. Here at Presidio, the large base of our revenue comes from an assets under management advisory fee. And so our compensation is greater the more money you have. Our compensation is less the less money you have. So you can rest assured that our interests are aligned and that we will continue to serve you as we have during good times and bad. And I know that right now our job is very important and we are all working very hard. Most of us working remotely to reach out to you and to serve you in this difficult time. And I also just want to thank everybody for the influx that we have had of referrals and introductions to friends, family members, and colleagues. This is difficult times right now. A lot of people don't have a Presidio. They don't have a personal CFO or fiduciary that is helping them. And they probably need it now more than ever. So please know that we are here. If anybody that wants to attend these future webinars or wants a consultation with us, or if you want to get in touch with us, please always know you can do so. Give us a call here at the office, 858-461-4959. Our office is ringing directly to all of our cell phones. You can get in contact with us at any time. You can send us an email at info@presidiocm.com. or you can visit our website. We've canceled all of our seminars here for the year, obviously, and not bringing in together any social gatherings for Retirement 101. So we do have the capacity to help you and your loved ones during this difficult time. If you would like to request an appointment, if you're new, you can go to our website, click the request an appointment link, go ahead and fill in the contact information. And of course, we should probably select the remote screen share versus in-person meeting during this time, something we've offered clients for a long time and we're well suited to do. Thank you guys. Go ahead and submit your questions to us. We'll be, I'll do my best to answer those specifically to you, responding to email. But thanks again for attending tonight. I hope everybody has a very safe, healthy, and happy weekend. And look out for more invites to our Presidio Perspective webinar. Thank you guys. Have a great night.